Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 3 of my multi-part video series called Financial and Retirement Planning Calculator Full Build-Out. In this video, we're going to continue walking step by step through the build-out of a financial and retirement planning calculator, so let's see where we currently are in the process. So if you recall from video number 2, we started step number 2 right here, calculating our after-tax cash flow. We kind of built out the structure of what the calculator is going to look like. And then we briefly touched on step 3, the allocation of our after-tax cash flow between current year expenses and net worth. And so in this video, we're going to continue the process of walking through these 2 steps right here so we can ultimately end up at step 4, calculating our net worth at the end of the current year. All right, so we're back over here on the cash flow projector tab for pre-retirement purposes. And the first thing we want to realize in this video is that this entire section right here, starting at W-2 wages and then scrolling down all the way through these different items, all the way down to our tax calculation, which starts right here, all the way down to this number right here on this line, income tax. This entire section that we just highlighted represents our tax return for the current year. And while taxes is certainly not the only component of our financial plan, it is the first component that we're going to start with on this particular tab. So while we are in the process of building this out, let's go ahead and drop our numbers into our personal 1040 US individual income tax return within TurboTax. All right, so scrolling back up here to the top of section 1 within the financial and retirement planning calculator, the W-2 section right here, we had previously entered $160,000 for 2024 for spouse 1 and $100,000 for 2024 for spouse 2. Now, while the total of these wages right here is going to be $260,000, what we are going to see over here on line 1A of our tax return in this fact pattern is going to be $230,000. Now, what is the difference? Why do we have $260,000 over here but $230,000 over here? To answer that question, let's go down here to this concept check on the W-2. Okay, so we're in the concept check, and what we want to compare for this example is what is the difference between what shows up in box 1 of a W-2 versus what shows up in box 3 of a W-2. So if we go over here, generally speaking, box 1 is income after the deferral to pre-tax accounts, whereas box 3 is generally income before the deferral to pre-tax accounts. So if one spouse has $160,000 of gross wages, that would be like what their stated wage is, and the other spouse has $100,000 of gross wages, then generally speaking, I would expect to see $260,000 total between 2 different W-2s for 2 different spouses. I would expect to see that grand total contained within box 3 of those 2 different W-2s. Now let's just say that combined, these 2 individuals contributed $30,000 to a pre-tax account, for example, a 401k. So if that was the case, I would expect to see $30,000 less between the 2 combined W-2s showing up in box 1 right here. So if we go back to our TurboTax example, I'm expecting the combination of all box 1s from the W-2 to show up right here on this line 1A, and that's the $230,000 combined in this example. However, if we go back over here to the cash flow projector, I'm expecting the full gross amounts, or the stated salary of $160 plus $100, to show up right here in this first section. All right, so if we have the full $260,000 gross or stated salary showing up right here, how do we handle the other $30,000 that was contributed on a pre-tax basis? Well, if you recall from what we were discussing in one of the previous videos, if I scroll down here, right here we have a $10,000 contribution to a 401k for spouse 1 and a $20,000 contribution to a 401k for spouse 2. That is our total of $30,000 that is being removed from taxable taxable income because it was contributed to a pre-tax account. Now you might be saying, well, why do we have to do it this way? Why can't we just put the net $230,000 up at the top where we just were? And I'm going to give you two answers to that question. The first answer is that there is no inherently right or wrong way to set up the calculator. We want to set it up in a way that is the most convenient to use and provides the most clarity in the information that we are calculating and tracking. And so in order to track the account value and ultimately our net worth over time, we need to be able to see somewhere what the amounts are that we contributed to these pre-tax accounts. In other words, I need a place to separate out this $30,000 so I can then bring it over here to the net worth projector, drop it in here into these accounts, and ultimately figure out what the net worth is at the end of each year. If I don't separate it out somewhere and I just put the net amount of $230 up at the top, then it makes it more difficult to track this 30 on a separate basis. So for purposes of the calculator, we're going to put the full gross stated salary, or generally what's in box 3 of a W-2, up at the top, and then we're going to back out contributions to our pre-tax accounts down here so we can ultimately arrive at a taxable income which excludes the $30,000. And for purposes of clarity, it will be more obvious within our financial and retirement planning calculator what's happening with the 260 versus the 230 as compared to the tax return presentation, which doesn't show the difference between the 260 and the 230. In addition to that, if I go back up here, we want to be able to project our salary out into the future. And the projection of our salary is independent of our decision to defer income into a pre-tax account. So for example, I could project this at 1%, I could project this at 1.5%, I could project this at 2%, I can project this at whatever percentage I want. It can vary for spouse 1 versus spouse 2, but that has no bearing on my decision about how much pre-tax deferral I'm going to do. As an example, I could do $10,000 of pre-tax deferral regardless of whether my salary is growing by 1% or 2% or 3% or whatever. So by separating these two items out, not only does it allow for better tracking, but it also allows us to project our gross salary at a different and independent rate than any decision about what we want to defer to a pre-tax account. So that is how we are going to handle the W-2 income as well as any pre-tax deferral within the financial and retirement planning calculator. Okay, the next item on our list is going to be investment income. This is a Schedule B item with respect to interest and dividends. So for purposes of this example, let's just assume that interest and dividends is what we have. We will deal with the nuance of having capital gain distributions in an upcoming video when we start digging into some real nuances of how the calculator is going to work. So for now, let's just assume that everything in this list right here is interest except for this $9,000, which is going to be dividend income in one of our portfolios. So if I go in here and add up all of these items here as well as this item right there, the total of that is $1,420 of interest income. We're going to assume for the moment that this emergency fund is invested in something that produces interest income as opposed to dividend income. And so that $1,420 is going to appear right over here on line 2B of the tax return, taxable interest. Let me just expand the spreadsheet for a second so you can see the summation of the items we have highlighted right here, $1,420. And then the only other item in this section right here that we haven't accounted for yet is this $9,000 of dividend income. This will appear right here over on line 3B. Here's our $9,000, and we're going to assume that of this $9,000, half of it, 50%, is going to be a qualified dividend right here. Now, if we think about this $9,000 of dividend income for a moment and we go back over to the net worth projector, which is where it was calculated, here is the $9,000 right here, and it is being included in our net worth. $300,000, $9,000, $50,000 of market return. We have that $10,000 of capital gain, which we'll get to on the cash flow projector shortly. Let me make the screen just a little bit smaller so that we can see exactly what this $359,000 of net worth with respect to this portfolio specifically consists of, and it is the $300,000 plus the $9,000 plus the $50,000. And what I want to focus on is this $9,000 specifically. Now recall from our video series on Roth IRA conversions on YouTube that ordinary dividends represents the total amount of dividends that were received in cash. In this case, we received $9,000 of cash dividend. So if we go back to TurboTax, here is the $9,000. Now this $4,500 right here, this does not appear anywhere in our list. And what was the reason for that? Because qualified dividends are a tax treatment. Qualified dividends do not represent additional cash. It does not represent an additional amount received. $9,000 is the only amount that was received in cash. What this says over here is that of this $9,000, $4,500 will receive a special tax treatment, and the remaining $4,500 will be taxed at your marginal tax rate, just like most of your other income. As I mentioned before, the special tax treatment related to qualified dividends will be handled through the ETR model that will be coming up in a future video. Alright, so that handles everything in this list right here. The only other item that is showing up above this section that we haven't covered yet is going to be this tax-exempt interest right here of $4,000. For federal income tax purposes, this is a reported but not a taxed item. And for our purposes over here, we're actually going to see that if I scroll all the way down past the tax calculation, you are going to see that right here. Here's the $4,000 of tax-exempt interest. That is an item that increases our cash flow, but it does not get taxed, so we have to put it down here after the tax calculation. All right, going back up here to the top, so the next item on the list is going to be $10,000 of Schedule C income from self-employment or running a business. That item is going to be included in line 8 of the tax return, additional income from Schedule 1. If we go over to Schedule 1 right here, we can see the item right here on line 3, business income or loss, attached Schedule C. There is our $10,000, which is this item right here. Next on the list, we have $10,000 of capital gain from one of our portfolios. We also have $10,000 of non-portfolio capital gain. If you recall from one of the last videos, this related to a disposal of land. Now, both of these are going to be a Schedule D item, but before we go there, let's just take a look at this next one right here, $15,000 of income from a rental property. The reason I want to mention that one right now is because that one is also listed on Schedule 1 right here, line 5, rental real estate, attached Schedule E, and there is our $15,000. So for purposes of this example, the grand total here of $25,000 is what's going to show up over here on the 1040. That's the total of line 8 right here, $25,000. And again, on our calculator, that's this $10,000 right here plus this $15,000 right there. Now, as far as the capital gain is concerned, we have a grand total of $20,000 right here between these two sections, and that's what we're going to see right over here on line 7, capital gain, attached Schedule D if required. There is our $20,000. Now, I want to come back over here and talk about the decision as to whether or not we want to project capital gain into the future along with the rest of our income. And so first off, strictly from a mechanical perspective, we have a toggle here now. Now, the answer to that is going to be heavily facts and circumstances based. For example, let's take this sale of land right here. It's highly likely that for an individual who owns one piece of land, this is going to be a one-time transaction. So in a situation like that, we probably would not want to project any additional capital gain related to land sales into the future. This item would be in 2024 2024 or whatever the current year is, and then the rest would be zero going out into the remainder of the projection. On the other hand, with capital gains and losses that are related to your portfolios, you will have to decide for yourself what makes the most sense under your specific fact pattern. For example, if you only sell securities once in a while, perhaps not even every year, like you hold positions for long periods of time and your selling is somewhat sporadic, then it is likely you may not want to project capital gain into the future, and instead you will just deal with capital gain in the year when it occurs, and you will not make any projections about what's going to happen going forward. On the other hand, let's say you have a relatively active portfolio and you do a lot of buying and selling, or perhaps you have a tax or other strategy that involves harvesting of capital gains or losses on some kind of consistent basis. In situations like that, it seems much more likely that you might consider projecting capital gains or losses into the future. So just as an example, let's say that this $10,000 of capital gain in 2024 represents like the minimum amount that you think you would recognize on an annual basis, or maybe the average amount that you would recognize on an annual basis in terms of capital gain. So if you believed that you would recognize at least a minimum or an average of this amount, then it wouldn't be particularly conservative to project zero at that point, right? You would want to project more taxable income, or an amount of taxable income which was equivalent to the minimum or average amount you think you would actually have. So in a situation like that, what we have over here is a new toggle, and I can just go into this cell right here and I can toggle this to yes. And if I choose to toggle this to yes, and this can be done by portfolio as you can see here, it will project out this amount of capital gain into the future. We also have the growth toggle right here. So if you want to project an increasing amount starting at 10,000, we could change this to like 1%, for example. On the other hand, any of the growth rates can also be included as a negative number. So let's say you're like, all right, I think $10,000 is going to kind of be the maximum that I would recognize. I do think it will be something going forward, but based on my portfolio and my age and my investment strategy, I have a feeling that it's going to like decrease over the years between this age and retirement. In that case, we could go in here and we could put in some negative rate like that. And in that case, we would at least have some capital gain recognition in our projections, but it could also reflect the fact that we think it's going to be a decreasing amount over time. So with these toggles right here, we do have some options with respect to capital gain. But again, if you don't want to project capital gain into the future, because unlike things such as wage income, which is generally, going to be consistent year over year, business income is often consistent year over year, rental income is often consistent, capital gain can be much more sporadic. And so it's going to be up to you based on your facts and circumstances. It certainly could be a no for the current year, but then maybe 3 years go by and you decide, you know what, my strategy has changed. From now on, we're going to make it a yes, and you can go from there. And then one more thing I might add right here. Let's say that you have a capital loss. So for example, if I go over to the Net Worth Projector over here, and for whatever reason we have decided to recognize a capital loss. Well, as you know, capital losses are limited to $3,000 per year if you're using them to offset other kinds of income, like ordinary income, like wages, for example. So let's say that instead of $10,000, we actually had a minus $3,000 right here. That would carry up here to the cash flow projector just like the gain would. Now, as I'm looking at this growth rate, I guess it would be okay to have a negative growth rate and decrease the amount of loss. But what would we not be able to have? Well, we wouldn't be able to have an increasing growth rate right here if we're dealing with losses, right? Because again, unless the tax law changes, this is going to be limited to $3,000. So if we were projecting to have $3,000 of capital loss going against ordinary income out into the future, and that could certainly be the case if you experienced a large capital loss in the past and were carrying it forward. In that particular case, we would just leave the growth rate at 0, which would reflect the reality that we're going to be limited to just $3,000 of capital loss in these future years. So that covers about all I want to say on capital gain at this moment. All right, we have covered this $20,000 of capital gain. We have covered this $25,000, which consists of business income as well as rental income. So let's go back over here and continue to scroll down. Now we have taxable income before income deferral of $302,420 in our calculator. But remember, that includes the full amount of gross wages. So we have to take out this $10,000 as well as this $20,000, both amounts that were contributed to a 401k. And recall that over here in the tax return, those amounts are already taken out of this number because this was box 1 of the W-2. Another item we have in our calculator here is a $7,000 contribution to a traditional IRA. Now this $7,000 goes over here into our net worth projector, just like the $10,000 and the $20,000 that we saw before. Back over here on the net worth projector, there's the $10,000, there's the $20,000, and there is the $7,000 right there. That $7,000 is cash going into an IRA. It increases our net worth. But coming back over here, the question is this a deductible item? And the answer in this case is going to be no, because both of these individuals up here are covered by a retirement plan at work. And we know that because they're both making current year contributions to a 401k. In addition to that, we're going to determine that their income is too high for individuals who are covered by a retirement plan at work. And therefore, based on current tax law, this $7,000 will not be deductible. Now, if you want to understand all of the nuances and rules as to whether a contribution to a traditional IRA is deductible in the current year, I recommend that you head over to my YouTube channel and look for the following video. It's going to be this one right here, Roth IRA conversion, non-deductible IRAs. If you search for that on YouTube, Number Crunch Nerds, Roth IRA conversion, this video will tell you everything you need to know about when a contribution to an IRA is deductible and when it is not deductible. Okay, before we continue, I'm going to go back over here to the net worth projector, and I'm going to go back up here to this capital loss of $3,000 that we had put in as an example, and I'm going to change that back to $10,000, which was the original amount that we had in there. By doing that, let's scroll back up here for just a moment and make sure that we have $10,000 of capital gain. We do. Okay, let's keep going. So we are back here in the pre-tax deferral accounts. We have covered this $10,000, this $20,000, this $7,000. Now we're going to talk about this $3,000 right here, which is a pre-tax contribution to an HSA. That item is going to be a Schedule 1 deduction, so we're going to go back over here to Schedule 1. This time we're going to scroll down to page 2, and we're going to find our HSA deduction right here on line 13, $3,000. And that $3,000 right there will carry up to the 1040, and it will show up right here on this line number 10, adjustments to income from Schedule 1. This $3,147, the $3,000 of it is the item we're talking about right now, this HSA contribution. Okay, we are now ready to go down here to Section 3, After-Tax Cash Flow Before Personal Expenses. Alright, the first line item is taxable income after tax deferral, but it's before a couple of other adjustments that we have to make right here in order to get down to this line, taxable income right there, which is $253,073, and that's the number we have on our tax return for taxable income right here on line 15, $253,073. So the adjustments that we need to make to this line, taxable income after tax deferral, are as follows. The first one is that we get a deduction for 1/2 of any self-employment tax that may be due. Self-employment tax is primarily going to be related to Schedule C income, or income that you receive on a 1099 NEC if you're an independent contractor. This is a relatively straightforward calculation, and we will deal with this when we get down here to creating our ETR tab to determine our effective tax rate. So for the moment, let's just note that that's $147, and that item is actually the 147 part of this 3,147 that we see over here. Okay, the next item is what we just talked about a few moments ago, the deductibility of any contribution to a traditional IRA. Now, because we are covered by a retirement plan at work and we are over this income threshold right here, this is the threshold for 2020 2024, we already said that that $7,000 was not going to be deductible. So what we have to do right here is add the amount back to taxable income. Now you might be saying, well, okay, up here we deducted it from taxable income, and now down here we're adding it back to taxable income, so it's a wash. If I adjust the screen here so we can see both, this is a subtraction to get to taxable income, and this is an addition to taxable income. So why are we bothering with that? Why don't we just leave this blank and just put this as 0 and then put this as 0 down here? Well, if what we were doing here was only figuring out what has to go on our tax return for the current year, then we could do that. We could just leave this as 0 and then this would be 0 as well. But that's not all we're doing. As we have said, calculating your tax for the current year is just one component of an overall retirement plan. Another component is figuring out and projecting our net worth into our retirement years. And in order to do that, I need to keep track of the amount that we're putting into our pre-tax accounts, including this one, so that when we go over to the Net Projector tab, we can add this $7,000 to our net worth and keep track of it. In addition to that, one of the silliest ways to pay too much tax over the course of your life is not to track non-deductible IRA contributions. That's what this is right here. It's an IRA contribution which is not deductible. But remember, when money comes out of an IRA, a traditional IRA, by default, it's going to be taxed unless you have specifically kept track of and are able to provide support that says that this was never deducted in the first place. If it's never deducted in the first place, then it doesn't have to be taxed on the way out of the traditional IRA. But if you forget about this and you don't keep track of it, then what happens? Well, first you get no tax deduction on the way into the traditional IRA, and then down the road you would get taxed on it on the way out, which means you are being double taxed on the same income. So you absolutely want to keep track of all of your IRA contributions, whether deductible or not, but certainly the ones that are not deductible. And so that's what we are doing right here. We're keeping track of this. It's a deduction to get to here, but then because of our retirement plan coverage at work plus this income threshold, this item is actually limited, so it gets added back to taxable income. And then the next item on the list is going to be our standard or itemized deduction. In this case, we're going to use the standard deduction. And finally, that's how we arrive at $253,073. All right, next up is our effective tax rate. Now, I want to do a video specifically on calculating our ETR as the facts and circumstances change over our life as we transition from pre-retirement to post-retirement. But in this video, let's just cover the basics. How can you calculate a basic effective tax rate really easily? Well, all you have to do is go into your prior year tax return. And before we continue, just in case you're new to my channel, those of you who've been watching for a while are familiar with this, but if you're new to the channel, I'm using TurboTax 2023 right now as a proxy for 2024 in this column, because as of the making of this video, the software for 2024 is not available. But for the ETR example that we're talking about, this works out quite well, because basically I'm going into my prior year tax return 2023, and I'm going to go right down here to line 24 of the 1040, my total tax, and I'm simply going to divide this $47,752 by my taxable income that is on line 15 right here, $253,073. Here's the calculation right here, $47,752 total tax divided by taxable income, $253,073, gives me an effective tax rate of 18.869%. And I take that 18.869% and I drop it in the first year that we are projecting. Let's assume that number came from the 2023 return, so we're using it as an estimate for 2024, and then we can project it out over the remaining years either with no growth or positive growth or a negative growth, just depending on what we think is going to be happening with our income over time. Now in this particular example, because I've set up this 2023 tax return to basically reflect my 2024 income, we are getting a projected income tax here of $47,752, which is identical to what we're getting over here. Now, of course, if this is your actual 2023 tax return and you are still doing this projection before 2024 is over, before your tax return has been filed, then this effective tax rate and the resulting tax is not going to be precise. It's not going to be the exact number that's going to be on your 2024 tax return, at least not at the time of the projection. However, once your 2024 tax return is complete and we refresh that starting point, like we talked about in the previous video, this will be updated to actual. And assuming we're expecting relatively stable income, at least over the next few years, then it would be a good proxy for if we are expecting drastic changes in our taxable income, that's when we're going to want to build this out in a slightly more robust way so we can make some adjustments for expected changes in income over time. Okay, so now that we have arrived at this line right here that calculates our income tax, then the portion of our overall financial plan that is representative of our tax return is basically complete. From this line forward, we're going to be working on after-tax cash flow. So let's think about this number on the next line. After-tax cash flow before non-taxable income. How do we determine this $227,668? Well, if I double-click on this, we will see that it's this $275,420 up here minus the income tax of $47,752 that we calculated right there. Now, why isn't it this number, for example, $253,073, the taxable income? Why isn't it this number minus the tax in order to arrive down here? Well, these adjustments in these three rows, this 147 and the 7,000 and the 29,200, let's take them one by one. So the 147 is a deduction, but is it a cash expense that is causing a deduction? In other words, did I spend $147 worth of cash in order to get this deduction? And the answer is no, I did not. This is just a statutory deduction, meaning it's a deduction allowed by law, which just happens to be equivalent to 1/2 of whatever self-employment tax we calculate. So this item has nothing to do with cash. Now, what about this $7,000 right here? Well, the cash impact of that was already handled up here in this row. We took this $7,000 of cash and we brought it over to the Net Worth Projector to be included right here in the balance of this account and ultimately be included in our net worth. The fact that we are now adding this number back for purposes of calculating our taxable income has nothing to do with the movement of cash. This is simply the tax law saying you can't deduct that from your taxable income in this particular circumstance. And so the amount has to be added back to your taxable income, but there is no cash movement associated with this row right here. The same thing is true of this standard deduction. This is just an amount allowed by law. It has nothing to do with cash. So these three adjustments on this line are just adjustments allowed by law in order to determine the number against which you will apply a tax rate. And then ultimately, once you apply that tax rate, you will get a tax expense, and this item is cash. This is something you actually have to pay in. So we're going to skip over these three items right here for purposes of calculating our after-tax cash flow. We're going to take this number at the top and we're going to subtract off this cash tax expense to arrive at this after-tax cash flow before non-taxable income of $227,668. So now, starting with this number right here, what other items do we have to add from a cash flow perspective? In other words, things that represent cash received but don't have a tax effect. In this case, we're going to have tax-exempt interest income. We're going to have gift income received. If you received the gift of income from somebody else, that is not a taxable item. And the third one is child support received. If you receive that, that is not a taxable item either. Now, my guess is that most people watching this video will not have all three of these items right here, but you may have something that is not included that is cash received but is not a taxable item. In that case, you could just remove one of these rows, or rather replace the description with whatever is applicable to you. So these three rows right here are effectively placeholders if these items are not applicable to your situation. So once we take the $227,668 and we add in these these three items, we get $232,668 of after-tax cash flow after non-taxable income. Okay, now I have two final adjustments to make in here from a cash flow perspective before we get down to section 4 to deal with personal expenses. And those two adjustments are going to be, I'm going to take out the taxable investment income related to Schedule B, and I'm also going to take out the capital gain income. Let's look at these one by one. By the way, if you're enjoying this video series and would like to fast track your financial and retirement planning, the complete financial and retirement planning calculator plus video training series is available for purchase in the link in the description below this video. Your purchase helps out the channel and provides you with a fully customizable and highly dynamic tool set that you can use for years to come to map out, refine, and analyze your family's lifetime financial plan. For more information on that, check out the link in the description below this video on YouTube. Okay, with respect to the interest income on Schedule B, where did this $10,420 originally come from? Well, it was from over here in the Net Worth Projector. So if you recall, it was calculated right here in this column. There is the $10,420. And after we calculated it, it was summed up into the total, which is over here. This total net worth right here already includes that $10,420. But then if you recall back over here on the cash flow projector tab, we brought that $10,420 in right here so that it could be included in taxable income and ultimately be taxed. So now if we've included it right here and then we scroll down to the grand total, which is this $275,420, that $10,420 is part of this number right here. And then ultimately after this section, once we have determined an after-tax cash flow before personal expenses, we are going to start taking away from this total all the personal expense items, and we will arrive at some remainder amount, something that is left over to be allocated to our net worth. If we don't take this $10,420 out right here, then it would be included in this number. Then let's scroll all the way down to the bottom. We're going to come back to these personal expenses in a little bit, but let's just see what the remaining amount is. All the way at the bottom, we allocated $28,567 to checking 1. Back over here on the net worth projector, there's the $28,567. So it would have been included twice. It would have been included here one time, and then it would have been included here as part of the remaining free cash flow that's taken back to our net worth. So the way I am preventing it from being double counted is after it gets taxed, the tax effect of it stays in this number, which is ultimately our cash taxes. But the income portion, the actual $10,420, we're going to take out right here so that it doesn't end up in our net worth twice. And then the same concept is going to be true with the capital gain income. So if we go back over here to the net worth projector and we look at portfolio 1, we said that this portfolio had $50,000 of gain in this particular year. And if I scroll out for a second, any cumulative gain that has been earned within the portfolio over time would already be part of this $300,000. So cumulative gain, whether realized or unrealized, through 12/31/2023 is in here. Gain for 2024, whether realized or unrealized, is in there. And this is just our tax recognition event for whatever portion of either this gain or the cumulative gain in here, or some combination of both, that we have chosen to recognize by selling securities, basically, in the current year. But as we already stated previously, the total gain or the total net worth at the end of the year just includes these three numbers, because the 10,000 is already either in here or in the cumulative unrealized gain or some combination of both. And that was true with the sale of land, and it's true with any capital gain We're simply taking whatever part of the gain we have chosen to recognize in the current year and bringing it over here to be taxed. And so just like the interest and dividends, it is included in this total number right here. It is included in this total right here. And so when we subtract our tax from this, it's still included in this number right here. The tax on that capital gain is part of this 47 and has been taken out, the cash tax that had to be paid. But the amount of capital gain itself is still sitting in this number. And so we have to take that out in order to arrive at cash flow. That's what this $20,000 is. It was $10,000 from the portfolio and $10,000 from that sale of land that we talked about in a previous video. So once we take the 232 and we back out those interest and dividends and we back out the capital gain, we arrive at our after-tax cash flow before personal expenses of $202,000 in this example. We will then take that $202,000 and we will subtract off all of our expenses, housing expenses, all these additional housing expenses, vehicles right here, other loans, insurance, healthcare expenses, and so on, all the way down to the bottom here. Total expenses is $168,681 in this example. That leaves $33,567 that's going to go into our net worth after all expenses. Of that amount, we have chosen to put $5,000 right here into a Roth IRA, and the remaining $28,567, as we said, went into checking one. So we go back over here, there's the $28,567. There's the pre-tax accounts that we dealt with earlier. There's the $3,000 that went into the HSA. There's the $5,000 that went into the Roth. And then as I continue to scroll down here, we also have amounts that went against our liabilities. All of these items right here were the principal payments on various loans. And so when we get all the way to the bottom here, we have $104,000 that increased our net worth. It was a combination of $30,000 that reduced principal on outstanding loans, plus this $73,000 up here that was a combination of pre-tax and post-tax accounts. We also have that $2,000 over here that came out of the HSA to go against current year expenses. So the grand total of this item right here plus this item right here is $102,017. And when we go back to the cash flow projector tab and I scroll all the way down to the bottom here, this section 7 total allocation to net worth check, this is a check that makes sure we captured everything. That's also appearing on the net worth projector page. Here is our 102,017 for the current year. And what does that consist of from the column above? It's everything we just talked about. It's all of the pre-tax investment account allocations. It's the HSA, it's the Roth, it's the amounts that went against the principal of debt, less that $2,000 that came out of the HSA to go against medical expenses. So we want to have built-in checks for everything we do. We want to make sure we have completeness. We want to be able to look at the same thing from two different angles and make sure that we've captured all the appropriate items. And so our check between the cash flow projector and the net worth projector, again, is total allocation to net worth here, should agree to this combination of two numbers right here on the net worth projector page. So that's going to be it for this video. In the next few videos, we will be working on projecting our net worth into the future. We will be digging further into projecting our current year expenses into the future. We will be building out our post-retirement equivalents of both the net worth projector and the cash flow projector. And we will also be building out the command center from where we can manage all of this data in one place and see how the results impact our plans and our net worth as we prepare for retirement.